I'm Darius McDermott from FundCalibre, and this is the Investing on the Go podcast. Today, we are delighted to be joined by Richard Woolner, who is a veteran and legendary fixed income manager, actually runs 3 elite rated products, which is the M&G Corporate Bond, M&G Strategic Corporate Bond, and the M&G Optimal Income Fund. Richard, good morning, and thank you so much for making time for us today.
Hello.
So look, who knew bonds could be this interesting? And here we are. It's been a busy few months in the world of bonds. What have you been doing in the portfolio that time? Have you made lots of changes because of that dramatic spike in yields?
It is quite interesting when 10-year gilt yields and 30-year gilt yields are appearing on the national news, obviously intertwined with the political issues and the budget and their effect on the economy. And it makes sense for them to be there. There's been a dramatic move in interest rates. That has been in response to the dramatic increase in inflation that we've had.
Yeah.
And as a value investor, when the markets become distorted or they become more lively, then it results in us thinking, is it appropriate to take some kind of action? And so it's been quite an active year from us, basically on the back of those big moves in interest rates. Interest rates have increased substantially, which means that you're getting paid more for lending than you were before. The opposite of the typical man on the street who and obviously has a mortgage, they have to pay more to borrow. Well, the flip side of that is that if you're a lender, you get paid more. It becomes more interesting to lend and becomes less interesting to borrow.
Yeah. So we get lots of acronyms in our industry, and one of the ones I think which you've been quoted as saying is we've gone from TINA to TIAA. What the hell do we mean by that?
Well, there was no alternative if you wanted to have an income and the bank account was zero and gilt yields was zero.
So TINA is there is no alternative.
There is no alternative. So that was the argument to say, well, equities are good value because the alternative is so bad value. It's a relatively good thing to have. And that's what you have to do as an asset allocator. You have to work out what, whether an individual or a fund manager, is it more attractive to own, let's say, cash, equity, property, and then obviously you work through which kind of equity, which kind of property, which kind of bonds do you want to own. And that's always a relative game. It's not an absolute game. Because it is always an alternative. You have a smorgasbord of things to look at, and
the new acronym,
but the opportunity set in bonds was very low because yields are very low. It's very hard to get negative yields, therefore upside was limited in the asset class. But obviously you can get yields returning to where they were before, which means you have downside. Now obviously it's a bit more balanced now. Interest rates can go down as well as up, whereas in the past it was very hard for them to fall. And you get paid while you wait. Before you weren't getting paid anything while you were waiting to see what happened next. You now receive income in bonds and corporate bonds and high yield bonds. So
TIA being there is an actual alternative.
There is an actual alternative.
And bonds being that answer across the
bonds are one of them. You might still prefer other asset classes, but you now have to take a more balanced view and say, well, actually, that argument for why we don't own bonds and own other asset classes is less strong. There is an alternative to how you look at managing your monies and what kind of asset allocation you have. Historically, bonds are looking more attractive than they were, obviously, at a time of zero rates.
Yeah, I couldn't agree with you more. Holding in a government bond yielding a half isn't really a recompense, whereas now I'm getting 3.5, 4. And when your skill set with credit comes in, you can actually get 5, 6, and 7 to hold an asset which should pull to par and mature at 100, given its maturity date. Yeah,
so the bonds have a set maturity date. Sometimes that's very near, and they're less volatile instruments. Sometimes that can be a long time away, and therefore, as interest rates move, they move a lot more. Just think of it as a bit like a mortgage. If you're locked into your mortgage for 3 months at a set rate and rates move or go right or wrong, it doesn't really affect you. But if you've got locked in a mortgage for 5 years, at a low rate or too high a rate, then obviously that economic decision is actually translates into either a very profitable or a very unprofitable decision.
Yep.
The same happens to the bond markets. And the bond market has a lot more term in it, so it's not a question of, let's say the mortgage market is 2 years on average, some 5, the occasional 10. We can actually go out to 30 years, and when we want to have that long-term income stream, we will take those risks on board. And when we want to avoid it, we'll avoid it and not take those risks within the mandates that we have.
Great. So just one question which points directly at optimal income. The optimal income is a strategic bond fund, but one of the differentiators that you put in place at outset was the ability to have up to 10% in equities. Given what you've said about bonds now being a genuine alternative, what have you done with your equity weight in, say, the last couple of years, and how do you view that in the year ahead, 2023?
We're looking at the optimal income stream, and the guidelines allow us to go up to 20% in equities.
Is it 20? Right, okay.
But it's a non-index bet for us, or non-index view. What we think is that every asset's value is a function of its income stream. The optimal income stream is about getting the highest number. It's about trying to get the best risk reward given the alternatives that we can invest in: investment grade, government bonds, high yield, and cash. Sometimes the most attractive income stream isn't in the bond; it's in the equity.
So the dividend.
It's the dividend or the earnings.
Right.
Where that dividend is realised now, or it's a future dividend that will pay out. And so if the equity part of the capital structure is very good value versus the bond part of the capital structure, we'd want to own that, because that's a way of really expressing your view about owning an asset that's very long dated because we really like it. Well, that's an equity because it hasn't got a maturity date. And also, obviously, you're at the lower end of the capital structure, i.e. the risky part of the capital structure, the bottom part of the company's capital, which means you're obviously a lot more volatile. When things go wrong, it's a lot more painful. When things go right, it's a lot more rewarding. And the other thing about equity is that people are very comfortable with the idea of high yield bond funds and high yield being in a portfolio like this. But you tend to find that equity is highly more correlated to high yield than high yield is correlated to government bonds. Because high yield has got many equity risk characteristics. It's at the bottom part of the capital structure. Things go wrong, they have high default rates. If things go right, you get paid well while you wait. You get more income. So I think that's one of the reasons that we use these bonds, use equities in the fund. At the moment, it's very low. The highest it was in 2012-13 when the equity market was very good value versus the bond market. Now, historically, the equity market is not as good value versus the bond market, and therefore it's a very low holding we have, because there's less companies exhibiting this capital structure arbitrage.
So last time we spoke in February, you talked about a 12 to 18 month lag from interest rate policy into the real economy. Where do you think we are, and does that still seem an appropriate time frame for these rising of interest rates to slow down the real economy?
Yeah, I think historically it's been observable, whether it be in the UK, US, Europe, elsewhere in the world. And the inflation we have now is a function of the very loose monetary policy we had 12, 18 months ago. In response to what's going on with public health and COVID. And what we have now is Bank of England starting putting rates up in the autumn to December of last year, 2021. And it'll take a while for it to feed through, which is why unemployment is still near record lows. That's why inflation is still high. Things work, the labour market is sticky, the housing market is sticky. It takes a while for things to happen. The bank have tightened policy aggressively and continue to do so, we think. They're also doing something in that they're doing quantitative tightening. And what that basically means is that they're destroying money, they're reducing the amount of money in the economy. Why does that matter? Just think of it as the more supply of something, the cheaper it is. The less supply, the more valuable it is. And obviously, if they print lots of money,
which they have done in two batches, one post-GFC over a multiple year, and again in COVID in very short order, a big chunk of printing.
Yeah, and I think they did it both times. The first time you didn't get inflation, you might ask why. I think that was they were just filling the hole from the previous excess consumption, the banking system. So they printed the money to bail out the banking system in the GFC. This time they were printing the money to bail out us.
Yes.
And then we get the money and we're going to spend it. No, that supply has been enormous. And that has caused, tends to cause inflation. Look around the world, the countries who printed the most money tend to have the highest inflation. The countries who printed the least money tend to have the least inflation. And they're doing that. They started to destroy it, not just in the UK, but obviously worldwide, in Europe, US. They're all changing them. They all had a very synchronized monetary policy of very low rates and printing money, and they're now all tightening. And it should, result in a slowing of the economy and a slowing of inflation. And if you were to be very sort of traditional monetarist, you'd argue actually that the destroying of the money does more to destroy inflation than it does destroy the economy. That what a pure monetarist would argue that it's the amount of money that matters to create the inflation, and its side effects on the economy aren't strong. And I think that's something that's very out of vogue, out of fashion. But it's pretty obvious we can get high inflation. How do we get this high inflation? Well, we printed lots of money. Well, how are we going to get back inflation back to normal? We remove that money from the system.
So 2022 has been a difficult year for bondholders. It's also been a difficult year for equity holders, particularly those in long duration growth assets. I've had a really tough year. At the centre of this is inflation, driving rates. Let's talk about then your view on inflation for the next year and a half, given that I'm allowing you 18 months because of the lag of maybe the last interest rate coming. What's your view on inflation? And if you could then finish it with what that means for bonds and potentially other asset classes over that 12 to 18 months.
I think central banks have signalled they want to get inflation back to target.
That's 2% or thereabouts.
2% thereabouts. Maybe they were a bit more aggressive pre this event, but they get inflation back towards 2%. They're late starting. They were late starting because they were facing a difficult problem. We didn't know what the public health issues were going to be in 2022, and therefore they run an aggressive monetary policy in 2021, probably assuming the worst. Unfortunately, society has reopened. So what they want to do is they want to get inflation back to target. And in the UK, it's quite interesting. And one thing that has changed from February, if you'd asked me then, I would have said that the government would be not pro-austerity. Boris would continue to want to spend. They would continue to want to go down that route. And that's almost, when you think about it, with the situation we've got in the UK with the brief mini-budget. But now that political will has changed, whether it be the European governments, the UK government, the European central banks, they're all looking to get inflation back into control. It is a priority. Yeah. And that gives the central bank permission to do as it is. And I think it will get it down. And you just have the natural things. You have a lag. The oil price in dollars is now back to where it was pre the Russian-Ukrainian situation. We will see the market come back just for a year-on-year effect as the oil price comes down. But secondly, I'm a firm believer that if they do stick to their guns and start destroying the money they printed, by definition, it has to increase its value. And it's very hard to sort of conceptualize, but the value of money going up is the same as inflation going down. Yes. Inflation going up is the same as the value of money going down.
Yeah.
So it's a very sort of hard thing. I think the simplest way to think about it, it's a very sort of weird way to think about it. Quite often when you look at markets, you think of the strangest thing you can do. So imagine if they said, okay, every £10 note's got a zero on it. Well, inflation would be enormous. They've printed a lot more money. If they said every £10 note's got a zero taken off, it's now a £1 coin. They've destroyed lots of money. So it's one of these things, and they don't do it.
But they're not doing it in one go. They're doing it slowly.
They don't do that. Certain countries have to do that. When you're in Zimbabwe, they do all sorts of things to the coinage and the value and all that kind of thing. But in the past, not anymore. I think, that's one of the key things that sat there. And as you rightly said, inflation coming down is actually not just good. If you think about an income stream, it's not just good for bonds, it's good for a number of asset classes, especially if it means that we don't tighten as much as we need to because inflation does come down. And then obviously it's a question to look at which asset classes are appropriately priced for these movements, which ones would provide the best risk reward. And that's an area where people have to make their asset allocation what they want to look at in this more like the economy slowing down, but not going into a heavy recession as inflation is solved by monetary phenomena as opposed to an economic phenomena of a recession. Then what kind of assets do you want to look at if you believe that is a potential outcome?
And then maybe one final extra question. We are lucky enough to work in financial services, savings, asset management, city. Do you think broadly everybody's a bit too bearish? And everybody I meet, recession, it's going to be terrible. Is that now the consensus and possibly wrong? Or do you think they're right to be bearish for a 12-month period?
It just matter. The question is, it doesn't matter whether you're right to be bearish or not. It's a question of what the value in the security you're willing to buy and sell is.
Yeah.
So you can be really bearish, but it's a great time to buy because the price...
You're buying it for 80p in the pound or 60p in the pound.
It's great. And you can be really bearish and the market is very expensive. You don't want to get involved. Same with bullish. You can be really bullish, but what are you doing buying it up here? So it really is a valuation view that you have to look through to look at where your view differs from how the income streams and those bonds are priced. And that's what we and the team I work with spend our time thinking through and working through to see where those risk rewards are, on balance more favourable. And that's what we spend our time doing. But it's as a bond investor, we tend to be naturally quite bearish people. We tend to avoid credits against difficulty. We tend to be biased that way. But I think whenever you see a general consensus, then you should look at the opportunities that can create. And I think, as you say, there's a general consensus that things are going to be really bad. The only way we get rid of inflation is to have an almighty recession. Well, if that doesn't happen,
things are cheap.
Things are different, and you want to work out where you want to be invested on that spectrum.
Richard, thank you very much for your time this morning. And if you'd like any more information on the M&G corporate bond, the M&G strategic corporate bond, or the M&G optimal income, please do visit FundCalibre.com. And if you've enjoyed this podcast, please don't forget to like and subscribe.
Thank you.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.